Today, we're diving into the intriguing trend of the bond market, the behavior of the 10-year yields following the Federal Reserve rate cuts. Since the Fed cut rates on September 18th, we've seen the 10-year yields rise by about 36 basis points. But is that unusual? Not really. This pattern has been evident in nearly every rate cutting cycle except for 2019. So why does this happen? A lot of it comes down to investor psychology. When the Fed cuts rates, investors feel more optimistic about the economy and the chances of avoiding a recession. This optimism often leads to increased investments in the stock market, thus pulling funds away from the bonds. Additionally, a fear that rate cuts might lead to rising inflation, prompting a sell-off in bonds. This psychological shift is a key factor in the fact that there's an initial spike in the yields. But remember, the Fed cuts rates for a reason. They're seeing a sign of economic slowdown, and this ultimately supports the bond market. It helps bring down inflation. Historically, after the initial rise in yields, they tend to fall again. Let's look at the data in the past cycles. The yields have dropped about 37%. For instance, on September 18th, the 10-year yield was 3.7. A 37% decline would bring it down to approximately 2.35. And when we factor in normal spreads, we could see a 30-year mortgage rate around 4.75 at that time. That's definitely within the realm of possibility. So what's the bottom line? The rise in yields following a Fed cut rate is more common than not, but after the initial spike, we typically see them go lower. It's a cycle that has repeated itself, and we believe it will continue to do so. I'm John Drennen, Sales Manager of VIP Mortgage. If you found this information valuable and insightful, please like and share it. Thank you very much for watching.